Let's get started with the first company's earnings that we got here that had earnings today. We got Capital One. Now, this company is interesting because it's a bank, right? It's a bank, Mike?
It's a bank slash card servicer. So
Yeah.
they're a small bank, so they're not really, well, comparative to like JP Morgan, Bank of America. They're not in the top.
All right, fair enough.
But they kind of deal more with card services.
Got you.
Yeah, it's like a Discover.
Yeah, and the reason why I'm bringing that fact up is because when I was putting in the numbers, I noticed that they did have capital expenditures. Banks don't have capital expenditures. So I'm like, we could use book value for this, or we could use this kind of free cash flow. To stick with the whole banks, you have to use book value, and it's better to use book value. We're going to use book value for this one, guys. But just FYI, they do have capital expenditures. You do a discounted free cash flow approach. Now, obviously, Capital One Bank, it's one of the biggest financial institutions here in the United States. No, I would argue it's what? JP Morgan, Bank of America, Citi, Morgan Stanley, and Wells Fargo, right? Those five? Mike?
Yeah, so the order, I'm going to say it in order of size for everyone. So JP Morgan, Bank, Citi, Wells Fargo, Goldman Sachs is 5, Morgan Stanley 6. USB, which is United States Bank, they're 7. I know TD's like 13 or 11.
Okay.
And I don't know where Capital One rates.
All right. Well, that's beside the point, though. It's still pretty massive, right? It's still a pretty massive bank. So let's get on with these earnings. Now, let's actually come over here and see, not the dividends. Let's actually see the earnings summary. Do they have this updated? No, they do not. So let's come over here. And, well, Capital One Financial, non-GAAP EPS of $3.52, beats by 28 cents, but the revenue missed by $130 million. So, how did the stock actually do? If we come back over here, we can see that it fell. It didn't fall as much as the tech companies, though, but it did fall 2.52%. Again, probably because of the fact that they did miss earnings, and probably because of also maybe bad guidance as well. We're going to take a look at the guidance in just one second. So, we're going to come now into the actual press release. And this is going to be interesting. I don't think I've done Capital One before. But I've never really, I don't think I've ever covered their earnings. So let's take a look at this. We got Capital One report second quarter 2023 net income of $1.4 billion or $3.52 per share. Capital One, okay, yeah, great. Here we have the statement from the CEO. Quote, we continue to lean into attractive opportunities to grow and build our franchise in our domestic card and national retail bank businesses. And our opportunities are enhanced by our technology transformation, said Richard D. Fairbank, founder, chairman, and CEO. Quote, our investments to build and leverage a modern technology infrastructure are expanding our opportunities and driving value creation over the long term. Do you see what they did wrong there?
Let's
Mike?
see.
Do you see what they did? No. You don't think. Do you see what they did wrong there?
Oh, they didn't say AI.
They didn't say AI, which explains why they fall 2.52%. Right? That's the way that we're doing it now, right?
Yep.
You gotta mention AI, guys. Come on. Modern technology infrastructure, just say AI. Come on, seriously. All right. So here we got now the second quarter income statement summary. Total net revenue increased 1% to $9 billion. Non-interest expenses decreased 3% to $4.8 billion. We got 1% decrease in marketing, 3% decrease. Wow. Oh, dear Lord. 1% decrease in marketing and 3% decrease in operating expenses. Pre-provisions earnings increased 7%, $4.2 billion. Provisions for credit losses decreased $305 million to $2.5 billion. Net charges of $2.2 billion. $318 million loan reserve build, net interest margin of 6.5%, a decrease of 12 basis points, efficiency ratio of 53.2%, operating efficiency ratio of 43.36%. All right, I want to take a look at some numbers though. I actually don't have anything here. Okay, so when it comes to this, apparently we're going to have to come over here and we have to take a look at the financial supplement. So they split theirs up for some reason. And guys, I do have the one that we just covered, this one, in the link in the description below. And obviously, if you guys would like to read along, Let me also put this one in the chat for everybody as well, just so that way you guys can follow along if you so wish to do so. All right, so let's take a look at some of these numbers. We got, oh, this is going to be really difficult to read, isn't it? I can already tell. All right, so we got total net revenue. Q2 of 2023, $9 billion. Q2 of 2022, 8.2. Wow, so that was a pretty big, that was a nice one. That was what, the total net revenue, right? Do we have anything else here? So this is this the percent increase over here? I believe so, right? Mike?
Yeah, I think.
That's the percent increase?
This quarter too, so yeah, that would be year over year.
Okay, it's just for some reason these don't have the percents here on the side. But okay, so that's the percent increase. And then on the 6 month ended, that was, let's see over here, from 2023 to 2022, it was a 200% increase. Dear Lord, absolute insanity, absolute craziness. All right, let's, what else do we got? We got net income, $2 billion to $1.4 billion. So that was a decrease right there. That was, wow, look at that, $2 billion down to $1.43 billion. Decrease of 30% when it comes to the net income. On the 6 month ended, however, it's a bigger drop of 46%. All right. That's not looking too good too far, though. Again, net total revenue is going up, but still, though, that is that's kind of concerning there. Not gonna lie, especially when it comes to the net income. Let's take a look at this. We got shares outstanding. Do we have anything here? Shares outstanding went from 383.8 down to 381. So that's good. All right, they're buying back shares, decent amount. And the dividends declared, they have not increased the dividend. It's still at 60 cents per share. All right, and I like, where do they have here? They have the tangible book value. Do they not have the book value per share? I wonder. Not fully certain, but nonetheless, though, tangible book value, we got $87.84 up to $90.07. So that in there just tells you a lot as to what this company, if it's overpriced or not. So yeah, guys, with that said, let's jump now into the discounted free cash flow, more specifically the banks/insurances calculated. We got the ticker for COF, market cap of $44 billion. That PE is already attractive, 7.93. That is, again, really attractive with the current share price of $115, almost $115, right? Now, let's actually take a look at this graph because, they did fall 2.5% today. On the 1 year, they're barely up, 0.2. Year to date, they're significantly up. They're significantly up 23.7%. 52-week range is $84 to $123.09. So we're nearing the 52-week high. Even after today, it fell. But I don't necessarily know. Again, just based off of the tangible book value, it's looking decent, right? It's looking decent enough. So, guys, let's come back into this. They do pay the dividend of $2.40, which, if we take a look at this yield, it is, honestly, I would have thought it would be bigger. 2.03% isn't anything major, though. What is attractive is this payout ratio of 16.79%, a 5-year CAGR of 8.45%, a 2-year increase, a dividend growth of 2 consecutive years, which I'm curious because did they cut it during COVID, I wonder? Let's see. Yes, they did. There it is. So they cut it from 40 cents down to 10 cents during COVID, but you can see that was only for 2 quarters, and then they started to bring it back up. They had a special dividend, I'm guessing, to like make it up, right? To make it up
Probably.
to make up this right over here. Special dividend of 60 cents, and then they brought it back down to, wait, what? Oh yeah, wait, what? I'm confused. Oh,
dividends.
Oh, okay, yeah. So it was a regular and a special dividend. That's interesting. I've rarely seen that, so that's why. Okay, so
they probably did it like capital reserves, right? And basically like trying to say, hey, we need to reserve capital, so we're going to cut the dividend, but then, hey, we didn't need this capital, so therefore here's your dividend that we owe you.
Right. By the way, make sure to check the YouTube chat, Mike. Just FYI. All right. Ex-dividend date passed as of May 12th. Payout date was on May 26th, and they pay their dividends quarterly. Coming back into this, we can see that based off of the current shares outstanding, which we did see that it is coming down a little bit, guys. It is coming down a little bit. They pay out $917 million every single year. Again, the payout ratio is looking really, really good overall when it comes to this. I actually like this. I'm not gonna lie. I'm actually fairly liking this from this perspective, right? When it comes to the whole earnings, the net income is a little bit of an issue, seeing that it is a drop. But let's take a look at this on the 5-year. Is there anything on the YouTube chat, by the way?
Yeah, so we got Don Miles saying, I'm excited to hear about American Airlines. Air travel has been stupidly busy this year. So let's see if it transferred to their earnings, because we'll also talk about oil a little bit because it's kind of indicating some stuff for like airlines and luxury. But let's see what American Airlines did once we get there.
Yeah. By the way, shout out to the 8 of you. Oh my lord, for starting our late stream. Shout out to the 8 of you and the 3 of you watching on Rumble as well. Guys, thank y'all so much. Again, please like. It really does help out the stream. It really does. We're a small channel. We would like to grow eventually and have this as our own business. So please, the best way, by liking, guys. It's free. It's free. It takes 2 seconds. Please, if you really enjoy this kind of content, that's really all we're asking for. All right, so let's jump into this 5 years of their fundamentals. When it comes to the net income, we got 5 years ago of $6 billion to today of, well, actually, okay, taking it back. 5 years ago of $6 billion to today of $5.9 billion. That is a decrease of 1.63%. This graph is all over the place, right? You're seeing this graph is all over the place. Massive drop during COVID, but that's understandable. Massive jump. What was that?
And then opening right back up. So
right. Yep. And then a massive jump the following year. And then, I don't know, man. What do you think about this?
You got to treat it like somewhat like a hybrid between card services and a bank. So
it's fair.
As the bank piece, it's getting affected by interest rates, but also as a card servicer, they're making more fees.
It's true.
Because a lot more people can't pay off their balances, because if you're taking your balance to basically minimum payments, they're incurring more interest, which therefore there's more fees that they can throw on and stuff like that. So they're, I want to say, sheltered a little bit compared to some of the banks, but it still doesn't point anything good comparative to what's coming down the pipeline, right? Like you're right at where you were 5 years ago. You basically went nowhere, and you had this big explosion in your stock price going into COVID. Came down back to reality, so you got to treat it like it's consolidating, right? So it's going to be moving capital, it's going to be doing different things. So it's, to me, it's like a 50-50 split, right? Like you really just don't know where it's going to go, and it has potential to go both ways.
So a 50?
Yeah.
All right, we'll keep it as a 50. All right, next we got the total revenue. Now, we did see this thing come up a little bit in their earnings, and this 50 is not for this. We got 5 years ago of 22.22. Wow, there's a lot of twos there. $22.22 billion to today of $27 billion, increase of 22%. This company just loves twos. Oh my God, 22%. You can see that it's interesting because the 5 to 4 years ago seems like it went down, but it's actually went up a little bit. The drop was 3 years ago during COVID, understandable, and then the massive jump 2 years ago, same thing. But then we see it drop 1 year ago. But as of today, again, remember, this 27 billion isn't done yet, right? We still got half a year, so you know they're $1 billion, $1.4 billion from reaching last year's revenue. Can they make it in half a year? I don't necessarily know, but it's just interesting that from 2-1 to today, assuming that today ends like this year ends right now, it would be falling, right? It would be falling. So what would you give this as a grade? Or at least give me your opinion and then grade.
So I think they can their earnings were $9 billion on the revenue. So they're most likely going to surpass current year to 1 year. So it skews you more to better grades, like an 85 or let's say an 85. Just because you did have some jaggedness, and like now you're proving that you're coming out of it, but now you don't get the higher score because you haven't had 2 consecutive years. So this be your first year of now an increase. Then next year, if you do showing an increase, then yeah, you get a better score. But right now you kind of have to keep it on a little penalized.
So 85?
Yep.
All right, 85. Next, we got the shares outstanding. Now, this is not surprising in the slightest. This is a massive, massive buyback on the 5-year. However, it's not consistently decreasing. We got 5 years ago of 467.7 million shares to today of 382 million shares. That is a buyback of 18.32%. And from the previous year to the current year is an increase, very tiny increase, right? 0.2, less than 0.2. So yeah, it's interesting. Now they also increased it as well during COVID, but that's understandable, right? COVID. So I'm looking at this and I'm just like, okay, the increases weren't that much, right? 456 to 459, and then from 381.3 to 382. It really isn't much of anything. So what would you give this as a grade?
I like it 95 because
95? Yeah, I agree.
It's strong. You're consistently decreasing. There's no major hiccups. COVID being a statistical outlier. It's interesting.
And today, of course, with the increase in interest rates and the stress on banks, not surprising that they increased their shares slightly, but it's barely anything, right? It's barely anything. So yeah, I agree with that 95% statement. And when it comes to the assets minus the liabilities, well, it was consistently increasing from 5 to 2 years ago, but then it dropped 1 year ago, but they're bringing it back up. That's interesting, right? That's probably because of treasuries? Maybe?
Most likely.
Yeah.
Every bank had their balance sheet turned upside down, so seeing that differential, it's not actually that terrible.
Right.
If you put it in perspective of it. So it's not necessarily the greatest graph, but I would say like 70.
You said 70? I would actually argue like a 75, honestly.
I would do 75.
Yeah, 75. I mean, average total assets, guys, it is... I didn't type anything down. Average total assets, it is $424 billion. Average liability... It's not like Bank of America or like JP Morgan, which is in the trillions. But average total liabilities, it is $367.61 billion. Doing the difference, we get $56.36 billion. I think it's a 75, honestly. I personally like 75. All right. So with that said, let's take a look at the overall grade when it comes to this, guys. 76. It's not bad, right? It's not bad. The big problem here. What was that?
No, not at all. It's pretty good. Especially for the situation banks are in.
Yeah, yeah. I mean, the main problem I see here is the net income. And again, when it comes back into their earnings, guys, we did see that the net income, it went down by 30% here on the 1 year, right? From Q2 of from Q2, wait, did it go down? What am I looking at? Am I being stupid? I am so sorry. Q2 of 2022, it did go down by 30%. So I'm looking at this. I'm just like, I'm looking at this. Then I'm looking at this as well when it comes to this net income. I'm just like, it's been coming down. I don't think that they'll be able to reach the 1 year ago value at their current rate. Just don't think so. So. Yeah. All right, but still though, 76%. The biggest problem here is the net income, but then again, they're buying back shares at a decent amount, a little bit issuing here and there, but overall it's still fairly good. Assets minus liabilities is all right. Revenue is looking fairly increasing as well. So yeah, it's at 76%. It's right at the cusp of it's slightly above passing, right? It's a solid C+. So interesting company. Now, what price should we pay for this company? Well, for that answer, we got to take a look at the book value per share. Now, this is interesting because current book value, it is $130.38. This has not been updated. If we come back over here, I don't think that they mentioned it, right? I don't think that they mentioned it. Let's find out. That's tangible book value. Do we got book value normally? No, it keeps showing me the tangible book value instead. All right. So we do got the tangible book value. We don't have the normal book value, but obviously, Seeking Alpha does have that. And guys, it's $130.38. There's an increase of 29% in the past 5 years. A massive jump 2 years ago, probably because of the stupidly low interest rates, right? That probably was a lot of people just taking out a bunch of cards and all that stuff. So that kind of explains that. 29% though, $130 is interesting. Tangible book value though, this is $90.73, and of course, if we take a look at this one more time, we can see that it is $90.07. All right, so let's update that. Let's say $90.07. So it did come down a little bit. That's interesting. $90.07. All right, and this is an increase of 30%. However, still fairly decent. But regarding the price, all right, here we go. If we do the price divided by this book value, Well, we can see that based on the book value perspective, this is undervalued by, 0.88 points. It's looking good. It's looking good. Tangible book value, though, this is the one that we do have updated based off of their earnings, and it is slightly overpriced, 1.28. Obviously, the closer to 1 you get, the better. Under 1's undervalued. 1.28, though, isn't too bad in my personal opinion. Again, meet it with the book value. You're pretty much like averaged at around, 1.1, right? 1.05, right, Mike?
Yeah, roughly.
So I'm looking at this, I'm just like, listen, from a book value perspective, it's looking fairly good. So what do you think about this so far?
I think it's doing fairly well for where it is, because it's not completely a bank, it's not completely a financial service company, so it's kind of walking that line. And they're doing it very eloquently, where they're not taking unnecessary risks, they're managing stuff. And being the 10th largest bank in the United States, I looked that up while you were talking.
Oh, okay.
It's in a better spot than a bunch of them.
I would argue it's in a better spot than Wells Fargo.
I would argue a better spot than freaking Citi.
Hey, don't talk about Citi. Don't you dare talk about Citi. No, but I personally, I think it's a better spot than Wells Fargo, though. So.
Okay, insert any bank.
Fair enough.
Is better Wells Fargo.
Fair enough. All right, so guys, from a book value perspective and tangible book value perspective, it's looking all right. A little bit expensive on the tangible one, but it's still, again, it's really up to your discretion. And with that, well, how much are we getting for this dividend? Because remember, the yield on this isn't really a lot. It's only 2%. So putting in $5,725, which, by the way, this number comes from the U.S. average income. All right, the U.S. average income. So putting in $5,725, this nets you $119.49 in annual dividends. I prefer above 200. 2%, guys, isn't necessarily a lot, but they do have a lot of prospects with, well, actually, I was going to say with this 5-year CAGR, but the 5-year CAGR isn't even double digits, right? Payout ratio is looking good, so you may have prospects for that. I don't know. You have the credit card services part of it and the banking side of it. Credit card services are really, really good when it comes to paying out, having a big CAGR. So, yeah, it's just 50-50 when it comes to this. All right, so would you like to do your technical analysis for COF? Good sir.
You're not going to call it voodoo magic?
No, I think I already I think I already messed with you enough
today.
Yeah.
you met the quota.
I love you though, Mike. Come on, man. Come on. You're my buddy.
So, if I look at this graph, it's very similar to the Russell. And so therefore we have to look at the Russell in order to kind of understand how this bank trades. A lot of banks trade with the Russell. So remember, that's your index that you're tied to, not necessarily the S&P. So just keep that in mind. You do have possibly head and shoulders here, but again, it's a pretty big pattern that has to play out by breaking these lows, which if you get the carnage piece of basically the banking sector and what we foresee coming, right? Like, on the horizon, that doesn't necessarily mean tomorrow, a month, to several months from now that it has to happen. And the simplest way I would play it is I wait for a pullback. Right now, it's had a nice little run off of earnings. If you get a retracement leg basically to the downside, and let's see if we got any patterns possibly that would complete up at this level. So they still got a 120 pattern that hasn't completed. So if this is your retracement leg, it looks pretty good. You could be buying it here. Understand that your risk tolerance, or how I would play it, is basically a 6% to the downside, and the 200 weekly is like, hey, you break this, get out. But you have a pretty clear risk tolerance. This doji candle on the daily does look like it's indecision, but that doesn't mean that it's bad, because you're running up, you have a doji gap down, you fill the gap, but still you kind of hold both ranges, and now we should see that continuation up. That's what I would be expecting if you're going to be bullish. I don't expect necessarily for you to come retest this area. I would be looking for a continuation to the upside and a simple A to B pattern basically that completes here to 121.46. That would be your next localized high before you have another pullback, which then results in another buying opportunity. So again, this could be a dollar cost average up situation, or possibly dollar cost average on the way down to this 200 weekly moving average if we get that retracement. But once you start breaking above this level of the 120s, that's when it really gets interesting, because you're coming back through price action that's not necessarily historically defined, compared to if you were trading sideways at this level for an extended period of time, then it would pretty much be known what it's going to do. Right here, it's pretty easy to move above the 120 mark because all this price action is recent. So again, you only have the localized price structure here to push through, which makes it easier comparative to if you're trading this jungle down here of it's just lobs of volume that don't want to move. It's basically trying to swim through concrete versus trying to swim through water. That's the analogy I would use. And if we just jump over here, and let me go to the company rather than covering Ally from yesterday, if I find it on the watch list. Yeah. So we can see this will probably give us a better idea. MACD is looking pretty strong right here, but it is curling towards the downside. So you could get that one more push again to the upside. RSI could cross, and then MACD would finally cross. The one concerning thing is you do have a divergence on the MACD, and that's basically price action is making a higher high here than here. So you really need to push higher, or you are going to have a divergence and then have a pretty good pullback on the way down. That's what I'd be looking for, that theoretical pullback to come back down into this 104 area, which would coincide again with these moving averages. So keep it in the back of your mind, there is risk to reward, but again, it could continue higher and it has a lot of room to the upside to run. You're pretty much free and clear to the 124, which is this area or node of resistance there that we're going to have to pile through once we get up there. So don't be shocked if you get a pullback once you get up into that level. Strong bullish volume pushing up and it's holding. So as long as you make weekly higher highs, which right now you're above, or actually at the previous week's top, not the close, you're at the week's top. So you want to see that continuation. If you fail to hold that, that will be considered a failed breakout, and then be looking at more bearish price action below. Again, with the weekly looking on this MACD right here, it looks more bearish on the weekly time frame. So you could get a short-term bullish run with a more significant pullback, and that would be one of those wait and see type of games, just because its earnings weren't necessarily the most stellar in like the initial perceptions. Not necessarily that they were, I'm just saying what the initial face value perception would be. And I'd be looking at those moving averages. Those moving averages would be a safer place to get in because you have a clear defined risk. You break the key levels on the moving averages, get out. You know, if they break back above, hey, you took a small loss, you can re-enter, and then Bob's your uncle, and you run it up all the way like no tomorrow. But if they continue to break, guess what? You just save yourself a crap ton of headache, and you have a clear defined risk to reward, which that's how you manage risk in the market. And I can't stress that enough. Make sure you read everything, make sure you do your due diligence, and have proper risk management. Just don't go willy-nilly buying stuff. Yes, it could go to the moon, and in the same way it can go to zero. So just be cautious.
Right, and again, when it comes to their financials are telling us that most likely a zero option isn't going to happen, but obviously, you know, a lot of stuff can happen. Nonetheless, though, guys, that was COF Capital One.